Budgetary control is a systematic management process that compares actual organizational performance with planned budgets, identifies deviations, analyses their causes, and implements corrective actions to achieve organizational objectives. As one of the most important functions of management accounting, budgetary control provides continuous feedback on operational efficiency, resource utilization, and financial performance. Through variance analysis and management reporting, budgetary control enables managers to evaluate departmental performance, allocate responsibility, improve decision-making, and maintain effective organizational control. Consequently, it forms an essential link between planning and performance management in both manufacturing and service organizations. Variance analysis using fixed and flexible budgets. The foundation of budgetary control is variance analysis, which measures the difference between planned and actual performance. Variances may be calculated by comparing fixed budgets, flexed budgets, and actual results. A fixed budget variance compares actual performance with the original budget prepared for a predetermined level of activity. However, because actual activity often differs from planned activity, fixed budget comparisons may produce misleading conclusions. A flexible budget adjusts budgeted costs and revenues to the actual level of activity achieved. Flexible budget variance is therefore calculated as. This comparison isolates operational efficiency by removing the effects of activity level differences. The sales volume variance measures the impact of producing or selling more or fewer units than originally budgeted. Similarly, cost variances compare actual expenditure with expected expenditure at actual activity levels, while profit variances reflect combined effects of revenue and cost differences. Variances are classified as favorable F, where actual performance exceeds expectations, and adverse A, where performance falls below budget. Relative significance of variances. Not all variances require managerial attention. Effective budgetary control emphasizes the relative significance or materiality of observed deviations rather than investigating every minor difference. The principle of management, by exception, directs managerial attention towards significant adverse or unusual variances that may indicate operational problems requiring corrective action. The significance of a variance depends upon several factors, including its monetary value, percentage deviation from budget, frequency of occurrence, trend over time, controllability, and strategic importance. A small variance occurring repeatedly may deserve greater attention than a single large, but isolated variance caused by exceptional circumstances. Managers should therefore evaluate variances within their operational context, rather than relying solely on numerical magnitude. Variance analysis becomes a management tool for identifying opportunities for improvement rather than simply identifying accounting differences. Eliminating variances. Variance analysis is valuable only if appropriate corrective action follows identification of significant deviations. Management accountants therefore investigate the underlying causes of adverse variances and recommend actions to improve future performance. For material cost variances, corrective measures may include renegotiating supplier contracts, improving inventory control, reducing waste, enhancing purchasing procedures, or identifying alternative suppliers. Labor variances may be addressed through improved training, enhanced supervision, workforce planning, productivity incentives, or revised production scheduling. Overhead variances may require better capacity utilization, tighter expenditure control, energy conservation measures, equipment maintenance improvements, or revised budgeting assumptions. Where revenue variances arise, management may review pricing strategies, marketing campaigns, product quality, customer service, or sales force effectiveness. In some cases, significant variances may indicate unrealistic budget assumptions, requiring revision rather than operational inefficiency. Responsibility accounting. Budgetary control operates most effectively within a system of responsibility accounting, whereby managers are held accountable only for those activities and resources under their direct control. Responsibility accounting divides organizations into responsibility centers, assigning financial responsibility to individual managers and facilitating performance evaluation. Responsibility centers commonly include cost centers, revenue centers, profit centers, and investment centers. Cost center managers control expenditure, but not revenue generation, while revenue center managers focus primarily on sales generation. Profit center managers control both revenues and costs, whereas investment center managers additionally manage assets employed and capital investment decisions. Responsibility accounting improves organizational control by clarifying managerial responsibilities, promoting accountability, motivating performance improvement, and facilitating decentralized decision-making while maintaining strategic oversight. Controllable and uncontrollable costs. An important principle underlying responsibility accounting is the distinction between controllable costs and uncontrollable costs. Controllable costs are costs that a manager can directly influence through operational decisions within a specified time period. Examples include overtime wages, material usage, departmental supplies, maintenance expenditure, and discretionary administrative expenses. In contrast, uncontrollable costs cannot be influenced significantly by the responsible manager and arise from decisions made elsewhere within the organization or from external economic factors. Examples include depreciation, corporate administration charges, allocated head office costs, taxation changes, inflation, and exchange rate fluctuations. Performance evaluation should focus primarily on controllable costs to ensure fairness and maintain managerial motivation. Holding managers accountable for uncontrollable factors may discourage effective decision-making and reduce organizational commitment. Management control reports. Budgetary control culminates in the preparation of management control reports, which summarize budgeted performance, actual results, variances, explanations, and recommended corrective actions. Effective reports should be concise, timely, relevant, and tailored to the information needs of different management levels. A typical control report includes budgeted values, actual outcomes, favorable or adverse variances, percentage deviations, explanatory comments, and management recommendations. Significant variances should be highlighted clearly, allowing senior management to focus attention on critical operational issues. Recommendations may include cost reduction initiatives, revised purchasing procedures, improved labor scheduling, capacity adjustments, enhanced marketing activities, revised forecasts, or budget modifications reflecting changing business conditions. Ultimately, budgetary control and reporting provide a continuous feedback mechanism linking planning with operational execution. Through variance analysis, responsibility accounting, and timely management reporting, organizations can monitor performance effectively, identify operational inefficiencies, implement corrective actions, and achieve strategic objectives while promoting accountability and continuous organizational improvement.